European gas spiked up 25% and Brent crude also up 10% to $80 per barrel as the Iranian conflict threatened global flows. Analysts see Brent crude rising $85 to $90 in the near term. The Organization of the Petroleum Exporting Countries has spiked its output, but that may not be enough to halt a further price spike if the Iran conflict drags on. On March 1, 8 OPEC Plus countries met virtually to review global oil market conditions. Given steady economic outlook and low oil inventories, they agreed to unwind 1.65 million barrels per day of voluntary production cuts from April 2023, with a new adjustment of 206,000 barrels per day scheduled to start for April 2026. The return of cuts will depend on market conditions, and countries may increase, pause, or reverse these adjustments as needed for stability. OPEC and partners have maintained steady output since December. However, analysts doubt that the recent increase will adequately compensate for disruptions to oil supplies from the Iran conflict. Hello, this is Global Business Insights, where we look at the world from a business perspective and bring you news, views, and analysis that helps to bring you up to date on the context. Crude oil prices are expected to jump this week as traders react to concerns the U.S. attack on Iran could disrupt oil supplies in the Middle East. If Iran closes the Strait of Hormuz, a narrow passage through which 20% of the world's oil supply flows, major oil importing countries depending on that trade route like China, India, and Japan would feel the supply bottleneck. Shipping costs will escalate, and so will energy prices. Iran produces about 3.3 million barrels per day and exports more than 2 million barrels per day, mainly to China. Trade sources report that Saudi Arabia and the United Arab Emirates have already started to boost their exports in preparation for possible disruptions. The US is the world's largest oil producer with 415 million barrels of oil in the US Strategic Reserve. In 2022, when Russia invaded Ukraine, a portion of this was drawn to calm markets. Analysts are reporting that the US is presently not considering releasing oil from its strategic petroleum reserve. This could mean Washington believes for now that any spike in prices after the Iran attack will be limited. Still, if the conflict does not end quickly in a worst case scenario, we could see prices reach $100 a barrel, spelling havoc on the global economy. If we do see this scenario, higher inflation will sap growth as interest rates go up. William Jackson of Capital Economics, for example, warns that a rise in Brent to $100 per barrel could add 0.6 to 0.7 points to global inflation. Disruptions to commercial shipping and air freight will also exacerbate costs for the global economy. Maersk, the shipping giant, is already rerouting commercial container vessels away from the Suez, compelling ships to take the more expensive detour around Africa. Iran has already launched retaliatory missile strikes on United Arab Emirates, Qatar, Bahrain, and Kuwait, forcing the region's airspace to be shut down. Israel has also carried out strikes on Lebanon after the Iran-backed militant group Hezbollah launched missiles at Israel. Many analysts are saying this as a war of choice, with little evidence of Iran acquiring nuclear weapons or intent to launch attacks on the United States and its allies and partners in the Middle East. You could say the US and Israel saw an opportunity to exploit the vulnerabilities of an adversary with little control of its own airspace, weakened regional proxies, and an Iran still trying to contain a popular civil uprising. Seeing there no match for the US, Iranian leaders have in the past chosen the path of restraint to allow them to remain in power. The US is also unlikely to want to pursue an extended war and may be content to just destabilize Iran enough to foment and awaken internal opposition and the dissatisfied population groaning under the oppressive regime. Trump has said they see this going on for 4 weeks. But that may not be the outcome, as outside attacks give the Iranian government supporters more reason to dislike the US and Israel. Also, the chances that Iran will transition to a stable, representative, secular democracy are slim. Also, as strikes continue to intensify, in an earlier joint statement with France and Germany, the UK suggested the three countries will support attacks on Iranian soil launched by the US and Israel for the first time. If the regime emerges intact after all this, it could also become as brutal as North Korea, and there's also the possibility of state collapse and a potential civil war given existing polarization. Many unknowns indeed. In the best case, Iran would become a tolerant representative democracy, or at least a stable nation focused on economic and national interests over ideology, allowing people to lead normal lives, similar to what many Iranians experience in Turkey and the UAE. So what about markets as investor anxiety heightens and traders lean to safe haven trades such as treasuries, gold, and the Swiss franc? Investors are probing further developments and gauging chances of prolonged turmoil. Higher oil prices also tends to drive traders out of equities as high energy costs erode corporate profits. Equities will see the initial dip as a near-term inflationary scare spooks the equity market. Asian equities tumbled this morning, and other global markets saw risk of selling. My take, in summary, is that the experience has been that geopolitical flare-ups typically tend to create only temporary sell-offs rather than sustained bear markets in most cases. Also, a lot of geopolitical risk premium has been priced in, and this attack could not be said to have shocked markets. But geoeconomic confrontation depresses business confidence, and that will weigh on global investments, especially in the new artificial intelligence space. We could see equities also eventually stabilizing as soon as Middle East developments are fully digested. Iran will have its day of revenge, but it will need to wait a while to catch the US off guard. For now, it seems, given military superiority and feeble reactions of Iranian allies like China and Russia, the US should easily paralyze Iran's air defenses, marine and naval infrastructure, and missile attack base, and extended conflict beyond a month is unlikely. Oil prices will see Brent climb to as high as $85 to $90 per barrel, maybe higher, driven by the supply shock linked to closing the Strait of Hormuz. Already the strategy of OPEC Plus is to recover market share lost to the US. So we will see Saudi Arabia, Kuwait, and UAE opening the taps to quickly replenish any supply gaps. There will be short-term panic buying, which could leave an expanded supply excess when the conflict subsides. Meanwhile, UAE stock markets are closed for 2 days amid Iran strikes. Still, the primary risk for markets is the uncertainty over what happens next in Iran. Another risk is a potential complacency and optimism that assumes the fallout would be limited, contained, and temporary. It may not. Some analysts expect Iran will not be able to materially disrupt trade in the Gulf region, and the impact on oil prices will be contained, but this is not known for sure. The US Federal Reserve is likely to adopt a more hawkish tilt, with inflation already near 3%, and energy shock makes the job significantly harder. For African oil exporters, especially those able to expand production, we could get a short-term boost to revenues, but imported inflation for import-dependent economies will mean more pressure on prices. Oil and gas importers like South Africa will see higher costs. To other stories, February ended with the S&P 500 logging its seventh slip in 9 weeks this year. The Nasdaq is also down in 7 of the past 9 weeks. The Dow Industrials, down in 6 of the past 9 weeks, also clocked their first close below the 10-week level since November. For February, the Dow gained 0.2% in the 10th straight monthly gain. The Nasdaq fell 3.4%, while the S&P 500 dipped 0.9%. March opens with the stock market reaction to Saturday's US-Israel assault on Iran, while oil prices, defense stocks, and energy stocks are expected generally to shift higher. Airlines and cruise line stocks could go down due to rerouting and fuel price concerns. Safe haven gold is up, and the US dollar could see gains as interest rates are expected to inch up. The US job report, which arrives along with retail sales data on Friday, highlights a big week for economic data. Economists are expecting non-farm payrolls to rise by 60,000. Also, Broadcom reports its fiscal first quarter results late Wednesday. Broadcom has benefited from strong sales of custom data center processors for Alphabet, Meta, platforms, and others. Chancellor Rachel Reeves will deliver her spring economic statement on Tuesday, aiming to highlight the government's stability following Labour's loss of Gorton and Denton to the Greens. Stronger tax revenues give Reeves a fiscal advantage, and she will tell businesses this is their stability dividend from effective fiscal management. She will also present updated forecasts from the Office for Budget Responsibility, which will be published after her speech. Despite the event expected to be low-key, it remains crucial for assessing the impact of recent budgets and government policies. Nigeria's GDP grew 4.07% year-on-year. That was in Q4 2025, outperforming the 3.76% rate from Q4 2024, following an improvement in both oil and non-oil sectors. Agriculture expanded by 4%, up from 2.54% in Q4 2024. Industry grew 3.88% compared to 2.49%, while services increased 4.15% against 4.75%. The services sector made up 55.92% of GDP in Q4 2025, slightly above the previous year's 55.87%. The oil sector saw real growth of 6.79% in Q4 2025, up from 2.08% a year earlier, and contributed to 0.87% to real GDP, marginally higher than the prior year's 2.8%. According to the Minister of Finance, Wale Edun, this GDP performance reflects improved fiscal coordination, disciplined expenditure management, stronger revenue mobilization, and progress in continued structural reforms aimed at restoring macroeconomic stability. An earlier report had stated that needed investments in the manufacturing sector were not forthcoming. Also, Nigeria's gas-fired power plants are reported to be receiving less than half of the fuel they need, worsening electricity supply. Shortages are linked to mounting sector debt from government subsidies, which operators say has risen to 6 trillion naira, that's about $4.4 billion this month. National generation slipped to about 4,300 megawatts, forcing load shedding and reduced allocations to power distributors to keep the system stable. Well, that's all we are able to take on this special edition of Global Business Insights. This is Bode Oshosani. Thanks for watching. Bye-bye.